The UCITS market in 2023 was marked by robust inflows into money market funds and bond funds. The net inflows into bond UCITS were fueled by the hiatus in central bank rate hikes and expectations of rate cuts in 2024. The strong money market fund inflows were primarily driven by shorter-term interest rate evolutions and the inverted yield curve for much of the year. Net inflows into equity UCITS were muted, and investors strongly preferred exchange-traded funds. ETFs had a record-breaking year in 2023, attracting 169 billion in net sales. Multi-asset funds, on the other hand, experienced net outflows in 2023, the first yearly net outflows of the decade. Net sales of SFDR Article 9, the dark green funds, declined in 2023, compared to their resilience during the market downturn in 2022. Article 6 funds, on the other hand, saw a turnaround, attracting strong net inflows this year. These trends were driven by the rising popularity of ETFs. Most ETFs track broad indices, and not all stocks and bonds in these indices meet the SFDR sustainability criteria. Such ETFs are then typically classified as SFDR Article 6 funds by default. The average annual performances of all major types of UCITS were positive in 2023. Driven by robust stock market growth, equity UCITS led the way, delivering high returns for both active and passive funds. Bond UCITS also performed well, with active funds slightly outperforming passive. Multi-asset funds and money market funds also yielded good returns. With an EU inflation rate of 3.4% for the year, most UCITS proved to be an excellent investment choice in 2023. Net sales of AIFs returned to positive territory, but remained relatively muted. Net inflows into AIFs reached 53 billion in 2023, compared to outflows of 60 billion the year before. The significant outflows during 2022 were largely due to Dutch and Danish pension funds shifting assets from AIF wrappers to segregated mandates. While this trend continued in 2023, it slowed down somewhat. Just like in previous years, the bulk of net AIF inflows were concentrated in other AIFs. These were funds like securitization funds, private equity or hedge funds. What these funds have in common is that they all invest in alternative, less liquid assets. Passive UCITS are steadily gaining market share. The surge in popularity of passive funds is due to a combination of lower costs and increasing investor demand for ETFs. ETFs, which are almost exclusively passive funds, attract net new money as a result of their flexibility, liquidity, and cost efficiency. Over the past 5 years, the average cost of long-term UCITS, both active and passive, has consistently decreased. This trend is expected to persist, driven by increased transparency on fund fees and intensified competition between asset managers. The share of US stocks in the asset allocation of equity UCITS has risen sharply since 2013, doubling over 10 years. This shift towards US stocks can in part be attributed to US stock markets outperforming European ones in recent years, in particular with the notable success of large US technology stocks. Another contributing factor was the strong demand for funds tracking global indices, which often have a considerable exposure to US stocks. EU retail investors continued to buy investment funds in 2023, but their focus shifted towards debt securities. Investment funds face direct competition from government bond issuances in several EU countries. Given the reluctance amongst banks to raise interest rates on saving accounts, national governments in countries such as Italy and Belgium successfully attracted domestic retail savers by offering higher yielding bond issuances, resulting in record-breaking acquisitions of debt securities.